Ladies and gentlemen, stay with me until the very end of this briefing, because what you are about to hear is not about headlines or military theater, but about a silent signal that historically appears only when nations are preparing for irreversible conflict. If you want to understand the real timeline of the next global rupture, you must stop watching aircraft carriers crossing the Taiwan Strait and stop counting fighter jets on a runway. Military assets are designed to be seen. They move for exercises, for signaling, for diplomacy, and they can return to port in days. They are the stage props of geopolitics. If you want to understand true intent, you must follow something far heavier, far slower, and far harder to reverse. You must follow sovereign debt. Debt is the foundation of the modern global order. It moves slowly. It takes months or years to unwind without breaking markets. And when a superpower begins dumping the debt of its primary rival at a pace that defies all financial logic, this is not portfolio management. It is preparation. This week, new data from the United States Treasury quietly confirmed what many have refused to acknowledge. We are going to conduct a forensic deep dive into the Treasury International Capital Report, one of the densest and most ignored documents in global finance. Most commentators glance at the headline number and move on. We are going to read between the lines. The data confirms a trend that has been accelerating for over a year and has now crossed a point of no return. As of October 2025, China's official holdings of United States Treasury bonds have fallen to roughly $688 billion. To most people, that sounds enormous. And it is. But in historical context, this number represents a catastrophic collapse. This is the lowest level of Chinese ownership since May 2009. 16 years of financial integration have effectively been erased. At the peak of the China-America symbiosis in 2013, Beijing held approximately $1.32 trillion in United States debt. China was effectively financing the American deficit. They bought the bonds that allowed Americans to consume cheap Chinese goods. Capital flowed in a closed loop that kept interest rates low and global trade stable. That loop is now broken. China has liquidated nearly half of its peak position, selling more than $600 billion in American obligations. Before we go any further, if you want clear analysis like this that goes beyond headlines and explains what the data actually means, subscribe to the channel now and activate the notification bell so you do not miss what comes next. But the most alarming part is not just how much China has sold. It is when they sold. Throughout late 2024 and into 2025, the United States bond market experienced one of the worst drawdowns in modern history. Interest rates were volatile. Bond prices were depressed. Anyone selling treasuries during this period was locking in losses. In asset management, you do not sell a depreciated asset at a loss unless you need immediate liquidity or you believe the asset is about to become dangerous. China does not have a liquidity problem. Despite domestic real estate stress, China continues to run a massive trade surplus. They have cash. The only conclusion consistent with the data is that Beijing has made a strategic decision that United States Treasury bonds are no longer a store of value. They are a liability. This conclusion makes sense only when viewed through the lens of February 2022. When Russia invaded Ukraine, the United States and the European Union froze roughly $300 billion of Russian central bank reserves overnight. Those assets were sitting in Western financial institutions and were rendered unusable with a few keystrokes. Beijing watched carefully. They learned a terrifying lesson. In a conflict over Taiwan or the South China Sea, United States treasuries are not protection. They are hostages. The $688 billion China still holds could be neutralized the moment sanctions are applied. So China is exiting. They are willing to accept a 10 or even 20% loss today to avoid a total loss tomorrow. This is a strategic liquidation, the financial equivalent of a burn notice. The speed of recent selling, nearly $12 billion in October alone, suggests urgency. Normally, central banks sell quietly to avoid market disruption. This time, discretion has been abandoned. Capital must leave United States jurisdiction, and it must leave now. This has massive consequences for the American economy. For decades, the United States could run enormous deficits because there was a price-insensitive buyer in the East. That buyer is now the largest seller,